Here's something nobody tells you in school. If you saved $500 a month starting at age 25 and never touched it, by the time you hit 65, you'd have $240,000. Sounds decent, right? Wrong. After 40 years of inflation, that $240,000 would have the purchasing power of about $65,000 in today's money. You saved diligently for 4 decades, and you're still not okay. And here's the part that should make your stomach drop. Millions of Americans are doing exactly this right now. They're doing everything they were told to do. And they're still going to run out of money. But what changes everything isn't working harder. It isn't even earning more. It's understanding a trap that the financial system almost never talks about. Most people grow up with the same money advice baked into them. Spend less than you earn. Save as much as you can. Don't be irresponsible. And look, that advice isn't wrong. Saving is good. Discipline is real. Financial responsibility matters. But here's where it breaks down. Saving is a defense. And you cannot win a game playing only defense. Think about it this way. Imagine you're trying to cross a river. Saving money is building a boat. Absolutely necessary. But the boat doesn't move by itself. Most people spend their entire lives building the boat and never actually rowing. They accumulate money in a savings account, earning 0.5% interest, while inflation quietly eats 3 to 4% of its value every single year. They feel responsible. They feel safe. And they are slowly, invisibly falling behind. The question isn't whether you should save. The question is, then what? Let me introduce you to two guys, both 26, both living in the same city, both making $62,000 a year. We'll call them Marcus and Derek. Marcus is careful with money. Really careful. He drives a used Honda. He packs his lunch. He skips the vacations. Every month, like clockwork, he moves $800 into his savings account. His friends joke that he's the most disciplined person they know. Derek is different. Derek saves too, but not as much as Marcus. He saves $500 a month. The other $300, he invests it. Index funds. Every month. Automatic. He doesn't think about it. He doesn't watch the market obsessively. He just lets it run. Now fast forward 10 years. Marcus has $96,000 in savings. Comfortable. Proud. Safe. Derek has $57,000 in savings, but his investments? They've grown to over $61,000. Combined, Derek is ahead. And the gap is only going to accelerate. By age 55, Marcus has a pile of money that inflation has slowly hollowed out. Derek has a portfolio that has been compounding quietly for nearly 3 decades. Same salary, same city, same starting point. Completely different outcomes. And here's what's wild. Marcus worked harder. He sacrificed more. He said no more often. And he still lost. So why does this keep happening? Why do so many disciplined, responsible people end up behind? The answer is hidden inside your brain. Your brain has a glitch when it comes to money. And it's not your fault. It's ancient wiring running in a modern world. The glitch has a name. Present bias. Your brain is literally wired to value today more than tomorrow. $1 you can spend right now feels more real than $10 you might have in 20 years. This isn't stupidity. This is survival coding from a time when humans didn't know if there would even be a tomorrow. But here's where it gets really interesting. There's a second trap layered on top of that one, and it's called hedonic adaptation. Every time your income goes up, your lifestyle quietly expands to fill the space. New income, new baseline. You get a raise. Suddenly your old apartment feels too small. You make more. Suddenly your old car feels embarrassing. And here's the brutal part. Studies show that after basic needs are met, lifestyle upgrades produce almost no lasting increase in happiness. You adapt. Within weeks, the new car becomes the normal car. The nicer apartment becomes just where you live. So you spend more. You feel the same. And the gap between what you earn and what you keep barely moves. This is why there are people in America earning $180,000 a year who are one missed paycheck away from disaster. It's not laziness. It's not stupidity. It's a psychological loop that nobody warned them about. And breaking that loop requires something most saving advice completely ignores. Here's the truth. The saving is enough crowd never tells you. Wealth is not built by accumulating money. Wealth is built by deploying money. There's a difference between a saver and an investor, and it's not just a strategy difference. It's a mindset difference. A saver thinks, how do I protect what I have? An investor thinks, How do I put what I have to work? Money sitting in a savings account is not resting. It's slowly being consumed. Every year inflation takes a bite. Every year the gap between your saved dollars and the actual cost of living quietly widens. But money invested in assets, index funds, real estate, ownership stakes in businesses, that money is working. It's generating returns. It's compounding. And compounding is the single most powerful force in personal finance. Einstein may or may not have actually called compound interest the eighth wonder of the world, but whoever said it first was right. $10,000 invested at 10% average annual return becomes $174,000 in 30 years. Without adding another dollar. That's not a trick. That's math. And it works whether you're watching it or not. The wealthy don't just save more. They use their money differently. They understand that idle money is losing money. And they act accordingly. So what do you actually do with this? First, save with a purpose, not a personality. Saving is a tool, not an identity. Build your emergency fund, 3 to 6 months of expenses, and then redirect every additional dollar you save into assets that grow. Second, automate your investing before you can talk yourself out of it. Set up an automatic transfer to a brokerage account on payday. Treat it like a bill. Pay your future self first. Derek didn't outperform Marcus through genius, he just automated a habit and stopped second-guessing it. Third, understand what you're fighting. Inflation is not abstract. It is a real continuous force that shrinks the value of every dollar you hold in cash. Knowing this makes investing feel less like gambling and more like survival. Fourth, start embarrassingly small if you have to. $50 a month invested beats zero. Every month you wait is a month of compounding you never get back. The best time to start was yesterday. The second best time is today. Fifth, separate your safety money from your growth money. Savings account for emergencies and short-term goals. Investment account for everything else. 2 different jobs. 2 different accounts. Simple. Here's the thought I want to leave you with. The people who look rich, the big house, the new car, the expensive wardrobe, many of them are renting that image. Financing a lifestyle they haven't earned. One unexpected expense away from everything unraveling. The people quietly becoming wealthy? You'd never know it. They drive normal cars. They live in houses that don't impress anyone. But their money is out there in the world, working, compounding, multiplying while they sleep. Saving money makes you responsible. Investing money makes you free. And the difference between those two things is everything.